freedom the new norm and wealth building the natural nature of habit. How prepared are you for this tax season? As a tax preparer, I see so many instances where taxpayers are not taking full advantage of the legitimate deductions and tax breaks that are available to them, all because they lack organization in their tax documents. They lack this organization in their receipts, and they lack this organization in their business bookkeeping. This lack of organized records can cost you anywhere between $500 to $10,000 or more, depending on your personal financial situation. In this week's episode of the Sophia Melonē Show, I'm going to share with you 3 simple tax preparation tips that you can implement immediately to get organized with your records in order to maximize your tax liability reductions. So let's get started. All right, guys. Hello. I am Sophia Melonē, the Debt Demolisher, and I'm super excited to be before you all today. I am the founder, and I'm here to deliver the midweek training to get you one step closer to your financial success. I am the founder and chief facilitator of Smash Debt Inc., which is a financial education company that provides financial leadership coaching, credit coaching, workshop facilitation, and foundational training and support for small business financials. And this is done all in efforts to create debt eliminators and wealth sustainers. So welcome to the room. I'm super excited to be before you guys today. We are now in the second week of March. The second week of March, and everyone is getting ready to file their taxes if they haven't already done so. But before you jump in and begin to file your taxes, you have to make sure that you are properly prepared to file so that it actually results in your financial advantage. So don't underestimate the power of a receipt or the power of your mileage. And for many reasons, more than business, for charity reasons, or for medical reasons, mileage can add up for you. And I know many of you maybe have already really don't understand like what the tax code is and what it means to have a standard deduction versus an itemized deduction, what it means to no longer have exemptions for dependents, and the list can go on and on and on and on. But what I really want you and need you to understand is how to be fully prepared for this tax season by ensuring that your tax documents, your receipts, your bookkeeping records, everything is organized, sufficiently supported, and collected in a manner that will allow your tax preparer to claim everything they can for you legitimately. So let me walk you through 3 simple tax preparation tips that you can start implementing immediately in order to better position yourself for an easy and advantageous tax filing year. So let's jump right in. I'm going to be sharing my screen with you guys so you can see my slides. All right. Prepared a little something for you guys. I try to be prepared, but before we roll into this, let me first read my disclaimer, since we are going to be talking a little bit about tax documents and tax preparation tips. And so for you guys to know, I am a certified financial education instructor. And as a certified financial education instructor, I serve in the capacity to teach and advocate for financial literacy. Therefore, all information shared via the Sophia Melonē and the Debt Demolisher, as well as my company Smash Debt, on all 3 of these platforms, are for informational and educational purposes only and are not for the purpose of providing professional accounting, tax, and or financial advice. So neither myself, Sophia Melonē, or my company, Smash Debt, will be held liable as a result of any inaccuracies or outdated information that is shared via their respective platforms through this training. So therefore, any and all information that you receive as a result of this training today, it needs to be independently vetted and verified before it is relied upon. Awesomeness. All right. So we are talking about taxes here. It's tax prep time. We are trying to get our returns filed. We're trying to rush so we can get a refund. But what I want you guys to really truly understand, that a lot of things have changed when it comes to the tax law. And some of the things that you may have received credit for, or if your refunds in the past were really, really high in prior years, and you're noticing as you filed last year, or if you've already filed this year and you feel like, well, my refund is a lot lower than expected, that's because tax laws changes. And that's because maybe you didn't include everything that you could have legitimately included in order to maximize all of your deductions for the year. And one of the key things that's so important to make sure that we maximize our deductions is through organization. And so we have to make sure that our paperwork is sufficiently organized and we have everything in place to fully account for everything that we've done, every dime that we've spent, every action that we have taken in the prior tax year. So right now we are in 2020, but you are filing your tax returns for activity and income that you've earned in tax year 2019. And so what I want you guys to really understand is, before you rush and you go file, you want to make sure that you have all of the information and all of the documentation that you need to bring forth to your tax preparer, whoever is going to be doing that for you. So one way to get organized, number one, is you have to make sure that you have all of your forms. Did you receive everything that you anticipate receiving? And I'm going to be walking you through some of the forms and things that you need to make sure that you look out for, just to make sure that you've considered everything before you go and file. Another thing is, you want to make sure that you have a system of record and a place to organize your records. So do you utilize manual folders, file cabinets to place all of your documentation in? Or are you more of a cloud person and you have all of your documents saved online? You retrieve your W-2s online, you retrieve your 1099s online, you retrieve whatever it is that your banking institution or your job or whoever you work with is able to disseminate that information to you in a cloud-based platform. Where are you saving that information? Is it properly organized? Another thing we want to look at as well is, how are we accounting for the activities that we've embarked upon last year and can legitimately write them off? So a lot of times we fail to leverage the opportunity of home-based business, small business, leveraging that platform, because we can be a business owner for a reason, and it can actually work to your advantage if you've sufficiently maintained all of your documentation, if you have all of your receipts, if you've legitimately registered your business and opened up your account and registered with the state and things of that nature. So there's different things and different aspects that we want to make sure that we're covering. But I want to make sure that you know that it's very important, especially as a business owner, that you have all of your records sufficiently supported, documented, either via bookkeeping platforms, or if you have your accounting services outsourced to someone else to do that bookkeeping for you. As I said, which I do bookkeeping for small business financials. All right, so what's your first tip? I was just sharing a little bit of that. You want to make sure that you get organized. How are you putting all of your documentation together? Have you received your W-2s? Have you received all of your 1099s? Have you received all of your investment income documentation? Did you pull anything from your retirement? Did you have any distributions from your retirement? Do you have self-employment? Are you a person who either works a full-time job and you work a side business as well as a parallelpreneur? You are technically considered a partially self-employed, and you can deduct any of those expenses that's attributed to the income that you're generating as a result of being self-employed. Also, you want to consider all of your income from capital gains. Did you even meet the threshold for that? And I'm going to be talking about that on the next slide. But I want you to think about organizing all of your documents. Think about all of the sources of income that you received in tax year 2019. Do you have a physical record that can support that activity? How many jobs have you worked? If you worked more than one job, then you should have more than one W-2. How many 1099 or contractor type gigs did you have? Was a 1099 issued for the income that you received as a result of that? Did you have any investments? Did you invest during tax year 2019? Were there any gains? You should either be receiving a 1099 for dividend income or miscellaneous income or something along those lines. So if you invested, you need to be making sure that you have your 1099 to support whatever dividend payouts you received as a result of investing for tax year 2019. Another thing is retirements. Did you withdraw or did you have a distribution? Did you cash out on one of your retirements? Did you receive a 1099-R? Another thing is cancellation of debt. This is something that's considered a 1099-C. And so a lot of people don't necessarily think that this is income, but if you are forgiven, if a bank forgives you or cancels a debt on your behalf for whatever reason outside of bankruptcy, it is going to be counted as income to you. And so what you have to do is you have to make sure if there was anything that was canceled, if you had any debt that was canceled legitimately by a bank, you need to make sure that you have that 1099-C in your records to make sure that you properly account for that income, because what you don't want is to not report income on your tax returns, because that's going to be a flag by the IRS, because at the end of the day, everything that you get in the mail, the IRS also gets. So you get a copy, the IRS gets a copy. That's how they know whether or not if you've claimed everything that you should have on your tax returns. They do have a threshold, kind of, so to speak, depending on if something was misreported. So if it's not anything that's like really, really huge or really, really material, you may be okay with that. But I want you to err on the side of caution of making sure all of your records are organized and making sure that you have documentation to support every activity that you've embarked upon or that you experienced in tax year 2019. So the same thing goes for your self-employment. If you were self-employed, maybe if you were hired as a contractor by someone, a lot of times they issue out 1099s. If you have like online stores, if you have what are those Shopify stores and things of that nature, they issue out 1099s. So you should have a 1099 that basically gives you how much your earnings were if you earned royalties, depending on what type of Shopify store that you have, because there are different types. But you want to make sure that you have every single source document that can support the income that you have coming in. Next, we're going to talk about deductions. Now, I'm going to do a little bit of an example on this, because when it comes to deductions, there's several ways that you could leverage deductions to reduce your amount of taxable income or adjusted gross income. That's a tax term that a lot of people may not necessarily be savvy of. But what that basically does is that it allows you to consider additional deductions that can decrease your income before it is considered income that could be further adjusted by either standard deductions or itemized deductions. So your pre-adjusted gross deductions will be things along the lines of student loan interest, So depending on how much money or how much income you earned, you're able to deduct up to $2,500 in interest expense that you pay towards your student loans, and you would get a 1098-E in the mail from your student loan provider if you've paid interest during tax year 2019. But there are some limitations in terms of what you may be able to deduct and what you can and cannot deduct, which I'm going to talk about coming up a little bit soon. But you want to consider those type of things that can be deductions before your standard deduction and your itemized deduction. So those things will be like educators deductions, that will be your student interest, that will be tuition and fees. So if you are in a qualified if you are a student at a qualified education institution, then you could deduct up to $4,000 of your, and the limitations may have changed, but you can deduct up to whatever the limitation is. I'm going to say 4,000 for now, in terms of qualified education expenses that you paid in the pursuit of a degree, right? So it has to be like an undergraduate degree, a master's degree, PhD, something along those lines. But you have to make sure that you have a 1099-T, which would come from your school, to document how much you've paid in terms of qualified education expense. So these things can be deducted as long as you have the forms to support it. Now, moving along to deductions that's after your adjusted gross income, these are things that will be either your standard deduction or your itemized deduction. And what you want to do is you want to make sure that this is allowing you to reap the biggest benefit. And I'm going to share some things that change with the itemized versus the standard deduction. But things that you can write off are cash contributions. So if you tithe, if you give donations to charitable contributions that are a legitimate 501c3 and they've been granted a 501c3 by the Internal Revenue Service, you could definitely write off those cash deductions. So do you have sufficient documentation to support your tithes and your offerings? Do you have sufficient documentation and receipts to support any cash contributions that you have given to any charitable organization that has a 501c3? In addition, do you have your receipts for your non-cash donations? A lot of times we give away things that are not of monetary cash. So if we have things in our home that we want to donate to Salvation Army, that we want to donate to those donation boxes, that we want to donate to so others may eat, different places, you need to get a receipt for that so you can confirm and show to the government, I donated these things. And there's another avenue that you have to take to kind of calculate the value of that, which is why you need a tax preparer or an accountant to work with you on that kind of stuff. But if you have your receipts to show your accountant or your tax preparer what you actually donated in terms of non-cash, then they can go through the process of helping you figure out what that deduction would look like on your tax return. Another thing for itemized deductions would be the taxes that you've paid. Again, there's a limitation on that because the tax law changed. So you cannot deduct more than $10,000 of taxes, and that is real estate taxes, that is property taxes, and that is also income taxes or sales and use tax. So you have the option to choose between deducting the sales and use tax that you've paid throughout the year, and this is tax that you pay on things at the store. So, but you have to keep your receipts to keep track of that, right? Or you can use the state taxes that you've paid through your W-2s, through your wages and things of that nature. So a lot of times people choose that route because it's documented in your W-2. But if you really sat down and maybe maintained all of your receipts and do the math to see how much did I pay in sales and use tax in a year, it would be interesting to do that exercise to see what actually turns out to be higher in a year. So I challenge you guys to do that. Not maybe this year, but maybe next year. And interest paid. So this is another thing that can be considered a deduction for you on the itemized deduction side, and that is for homeowners. If you have a mortgage, if you have a mortgage, then you can deduct the interest that you've paid as a result of paying the mortgage. And normally your mortgage provider will give you the total amount of interest that you paid on that mortgage loan. Another thing you want to consider too is the fact that the tax law has changed regarding if you've refinanced in the past and used that money for things other than making improvements to your home, then the interest associated with that is not deductible. So you have to make sure that you are aware and knowledgeable of what could potentially impact you from a negative standpoint on your tax returns, and then what actually works to your advantage, which I'm going to be talking about soon. Last but not least, you want to make sure that you are organized in your business receipts. As I mentioned, if you are a parallelpreneur or if you are a solopreneur, you have to make sure that you have all of your stuff documented. Everything that you've paid for in connection to your business needs to have a receipt or some way that it can be fully substantiated. As a former tax auditor, I saw this a lot. People claim business taxes or business losses or different things, and when they would get flagged for audit, they didn't have the documentation to support their claims. So what happened? It got disallowed. And when your claims get disallowed, what happens is your whole return gets adjusted. And so that refund that you thought you were actually going to get actually turns into a liability. And now you then in turn owe the IRS as well as your state money because you got a refund on something that may have been legitimately an expense that you've incurred, but because you couldn't substantiate it, it couldn't be allowed. So I stress this so much with people who are business folks, entrepreneurs, parallelpreneurs. You have to make sure that you have sufficient documentation to support your business records. The IRS does not play with stuff like this. So you have to make sure that you have your receipts. You have to make sure that you have your invoices. And not only that, you want to make sure that you're organized with your mileage. So anything that you do in connection to your business is a legitimate expense that can be written off. And that includes mileage. That includes you driving to taxpayer client sites or driving to meetings or driving to different events in connection with business. If you track it, you can deduct it. If you can support it, you can deduct it. And if you can tie it to a legitimate business need, you can deduct it. Next tip is to make sure that you review all of your prior returns. So one thing that I think is very important to do, especially if you are changing tax preparers, is to have your last year's return handy, just so that they can see what were some of the things that you claimed in the past compared to what you are potentially claiming for this year. And so you want to make sure that you have all of your necessary forms. So your forms will be your 1040. That's the individual tax return. Your other forms that could be connection with you, if you have a LLC or if you have an S Corp, is an 1120S, which is an X corporation tax return. Another type of form is your 1065, which is your partnership return if you are involved in a partnership, because that money typically flows through to you, which to you or the individual taxpayer, which is why I have these forms referenced here. So it's important to make sure that you have all of that with you, have all of that in front of you, and that way you can look at it to see if something seems relatively off when you're doing when you're having your tax returns prepared for filing this year. You want to also look at your schedules. Your Schedule A is the itemized deductions that I was talking to you about, if you are able to do that. Some people don't use a Schedule A because the Schedule A deductions that they have may be a lot less than the standard deduction. And you want to make sure that you're choosing what's most advantageous to you. And that would be the higher of the two. Next is your Schedule C. So if you are a business owner, if you are self-employed, 9 times out of 10, you're going to be reporting that type of activity on your Schedule C. So make sure that you look at your Schedule C from last year to see what was reported compared to this year. Schedule D, Schedule E, which is all related to royalty, capital gains, different things of that nature. You want to make sure that you're looking at that and having all of your schedules. Your K1s is tied to your 1120S or your 1065. So it's important to have these things in front of you just so you can review for compare and contrast. Records, again, I'm going to stress the importance of making sure that you have that information available for you. So your 1098s, your W-2s, your carry forwards is a big thing. So if there was a loss that you weren't able to deduct last year, 9 times out of 10, you're able to carry that loss forward. So you want to look at your last year's return so you can see if there's any carry forwards that you need to incorporate so that you can take on that loss in this year. Okay. Tax tip number 3 is to make sure that you research the changes in the tax law. So, and you don't have to do extensive research, but you want to do enough research so that you are aware and you have a general understanding. One of the things that I think could be a hindrance for most people is because they really don't want to really get involved with the tax. They think it's this big, huge thing, but honestly, it's nothing but language. Even though it's a lot to read, it's easy to grasp if you just take the time to just look at some stuff, see what's changing. And there's a lot of blogs and things that are written that give you a high level summary of what changed from last year to this year, or what changed from the year before to this year. So it's important that you take a moment to look at these changes and ask yourself a couple of questions, like what changed in the tax law between last year and this year? And how will that impact me, right? What was I able to claim last year that I may not be able to claim this year? Another thing, we want to look at our treatments. Are there any new tax treatments to consider? Because there's certain things where certain stuff may be phased out, or they may be different treatments because of changes in tax law. So you have to look at how are the changes from before it's going to impact me now? How are the treatments different compared to how the treatment was last year? And then you also want to look at your limitations. Are there any limits that are applicable to your tax liability? Like I was saying, there's certain things that you can't deduct if you make too much money. So if you make over a certain dollar amount, I think it's $80,000 or something like that, depending on your filing status, you won't be able to claim your student loan interest because you phased out. So you want to make sure that you're looking at your limitations. You want to make sure that you have a general understanding to see what you can and cannot deduct, just so you can have that awareness. And when you're looking at your returns for whoever does your return, you're able to kind of question them a little bit, because a lot of times people do fraudulent things, and you don't want to be caught in a situation where you're filing a return and you can't support what in the world they put on your return. So make sure that you have some general knowledge and you're doing your due diligence and you're researching the tax law to have a general understanding of what changed and how that might impact your tax liability. So one of the big things that was a huge change for this last, well, not this year, but that it was last year and this year too, so you're really going to see it both ways, is the elimination of the exemption allowance. So I have a comparison to show you what the exemption allowance did for tax year 2017 versus tax year 2018. And so it is important for you to just kind of think about what is happening here. So when we look at this example here, 2017, if you were head of household, because normally the exemption allowance really benefited those who had dependents and people who they can claim. So if you have someone who you can claim, 9 times out of 10, your filing status will be head of household, if you meet certain elements that I'm not going to go through right now for the sake of this training. But in 2017, if you were head of household, then you were allowed an exemption amount of $4,050. And you were allowed that same dollar amount for each dependent that you have. So let's say, for sake of example, you had a household, you had 3 dependents, and let's say you didn't have enough to get the itemized deduction. So you're going with the standard deduction, right? So if you have 3 dependents and you have yourself that you could actually claim as a dependent, where does that put you in terms of positioning with your exemption amount? So that will allow you, if you have head of household exemption for each of your children, and you have a standard deduction of $9,000, that allows you to lower your adjusted gross income by $25,550. Okay. Now, when we look at the change, because this change actually became effective for tax year 2018, which was when you filed last year in 2019, they've eliminated that. So you can no longer get an exemption for you, your children, for anything. So in 2018, your exemption allowance for yourself, 0. 2018, your exemption allowance for your children, 0. But what they did in efforts to try to offset some of this is increase the standard deduction. So they essentially doubled or almost doubled the standard deduction to $18,000, but that's all you're going to get. So if you look at the comparison, this is showing you if you had exemptions, right? If you had 3 or more or whatever, you could potentially have a huge reduction in your tax liability as a result of this exemption. But because it's been phased out and the most that you can get in standard deduction is $18K, the difference between that 25 and that $18K is $7,550. And that $7,550 can cost you anywhere between $1,700 to $1,850 in a tax liability. And that's depending on your tax bracket. Because what I'm looking at is, I'm saying, okay, I could have potentially had an additional $7,550 as a reduction to my adjusted gross income. And if my tax liability was 22% or 24% based on the tax brackets in 2018, that's going to be anywhere between $1,700 and $1,800. Now, what could you do with an extra almost $2,000, right? So when you think of these things, and this is not even including those folks who have businesses, who may have incorporated business losses, who may be even able to itemize. So if you think about the extrapolation of what can happen, if you have all of your documentation sufficiently supported, if you've leveraged the opportunity to operate from a home-based business so you can take these tax write-offs, this is for your benefit. So if you miss out on that and you don't leverage it, it's going to be costing you a lot of money over time. So I just want you to think about the example that I'm sharing in terms of the changes in the tax law and how that could potentially impact you. And this was just one example. Okay. So you guys know that I love to give you homework. And before I give you homework, I need you to make sure that you, number one, subscribe. So if you're new to the channel, please make sure that you subscribe, hit the notification bell. One of my missions is to make sure that I am delivering value and tangible information that people can apply, just to gain a general awareness of how to better improve their finances from a 360 perspective. And however I can share this information with you, I will. So use this information to your advantage, but make sure that you have it vetted, as I said in my disclaimer. But subscribe and make sure that you come back, because I'll be dropping new episodes each and every week. All right. So for your homework, as I've already shared 3 tax preparation tips that can make your tax filing easy, I want you to get started on your homework by, number 1, getting organized. I've already shared with you what you need to make sure that you have included, avenues that you can do to basically create your filing system, if it's going to be cloud-based or manual-based, like meaning like actually printed file folder kind of thing. Do that. Make sure that you have all of your things in order. Number 2, I need you to make sure that you review your prior tax returns in comparison to see if you're actually missing out on anything, right? Because sometimes we forget. And so our prior year tax returns can serve as a refresher to make sure that we have everything that we need. And then you can question yourself to say, okay, did I not do this activity last year because I reported it the year before? Then you want to make sure that you research the tax law changes and just make sure that you are abreast and have a general understanding of what's new, how it impacts you, and use the automated tools that the IRS has to do like preliminary estimates of what the potential impact could be for you, because a lot of times you may not understand the tax verbiage, but the simulator may help you get better answers and get a better understanding. So do that, do your due diligence, conduct your tax research, and that way you're able to question and better, not really challenge, but make sure that you're able to fully certify what you're sending forth to the IRS, even if someone else is preparing it on your behalf. Then I want you to make sure that you go ahead and do that calculation for yourself. So looking at your prior year's tax return, look at it and see what was the change between the last time that I was actually able to leverage the exemption piece compared to now. How am I better off? So calculate the exemption allowance elimination impact on you and your tax preparation. And once you get it prepared, so that way you can really have a better understanding of what it actually cost you, what that tax change actually cost you. And in some cases, it could actually benefit you. You know, we just never know, but you won't know until you calculate it. All right. So, I want you to make sure that you subscribe if you haven't already. Thank you for joining me. Thank you for being in the room. I know this is a late segment, but it's been a day, and I am committed to making sure that I deliver training to you each and every week. And so we're here. So subscribe and make sure that you come back. And then once you've subscribed, go ahead and drop a comment stating the value of what you learned as a result of this training. I know I shared a lot. We are over 30 minutes in, so there was a lot of gems shared. So all you have to do is just indicate what you learned and what you took away from this training and what you will implement immediately. And then after you've done that, share this with a friend. Don't leave all the juice for yourself. Give someone else's wisdom. Challenge someone else to go through the same process before they run and file, so that way they can maximize their refund that they could potentially get. Share this out. Don't leave all the juice for yourself, because sharing is caring. And then after you shared it out, I want you to make sure that you join my mailing list by going to sophiamelonē.com, as I share debt demolition tips on a weekly basis. And I also give the inside scoop on private trainings that are forthcoming, that are offered through my company, so you don't want to miss it. All right. And so I want to remind you that your financial prosperity awaits you. Stay in action, be intentional, and come back next week as I have more tax tips to share with you for the month of March. All right. Have a wonderful night.